got a question. Is 80/20 actually good? And the answer is more complicated than you'd think. I'm head of content at Joinprop, and welcome to episode 20 of the Joinprop podcast. And I'm just going to, well, I'll toss it right over to you to get us started.
Toss it over to me to explain what we're even doing, because I have the notes you sent me this morning, and it is literally just a list of fractions like 80/20, 70/30, 90/10. Are we talking about the Pareto principle?
Cool.
Or I don't know, ground beef ratios at the grocery store? Because I am completely lost already.
No, not beef. Sorry, I do this a lot. I get so far into the weeds with this stuff that I totally forget to zoom out and set the actual stage for people who aren't, staring at trading charts for 12 hours a day. We are talking about profit splits today, specifically in the proprietary trading world, prop trading.
Okay, so let's back all the way up then. Pretend I just wandered in off the street, which, financially speaking, I basically did. What define profit split in this specific context? Because the way you phrase it, it sounds like we're robbing a bank and trying to figure out who gets the bigger bag of cash in the getaway car.
I mean, it's not entirely unlike that, just, minus the federal felonies.
Yeah.
So look at it this way. A proprietary trading firm, a prop firm, right? They have capital. They have the money. Literally millions of dollars just sitting in accounts. You, as the retail trader sitting in your bedroom, you have the skill. Or, well, at least you claim to have the skill to read the markets. But you don't have millions. You maybe have, I don't know, $5 grand, $10 grand to your name. You definitely don't want to risk your own life savings on a wildly volatile market.
Right, because if I lose my own $5 grand, I can't pay my rent next month.
Exactly. So the firm comes in and says, okay, trade our money. We will give you an account with, say, $100,000 of our capital. If you lose it, that's on us. You don't owe us the lost money. But, and here's the catch. If you make a profit, we carve up those returns based on a predetermined ratio.
And that ratio is the split.
That's the split, yeah.
Okay, I'm with you now. So the mission today is to basically just tear apart these numbers. Because I see people arguing online, like on Twitter, Discord, wherever, all the time about getting the absolute highest split possible. And I don't know, it always feels like there's a catch. I want to figure out why some of these firms are offering these insane numbers, what that catch actually is, and how someone listening to this can navigate the fine print to, well, actually get paid more without falling into some weird trap.
Right, because you really can't know if an 80/20 split is quote-unquote good until you know what normal actually looks like across the entire industry. You have to establish a baseline first, like who is getting what and why.
So what is the baseline? If I sign up tomorrow, I pass whatever evaluation test they give me, what am I getting?
Well, it's tiered, and it's highly dependent on the firm's specific business model, obviously. But the standard structures usually break down into 3 levels. Entry level, which is where almost everyone starts if they're coming in cold, is usually anywhere from 50/50 to maybe 70/30. So best case scenario, at the entry level, you keep 70% of the profits you generate, and the firm keeps 30.
50/50 feels a little, I don't know, stingy. Like if I'm doing literally all the analytical work, waking up at 4 a.m. to trade the London Open or whatever, and they're just passively providing the funds.
You're doing the work, sure, but they are taking literally 100% of the financial risk. Think about it. If you blow the account, you walk away. You lose your access to their money, but you don't lose your house. They lose the actual capital. So 50/50 at the entry level is just them hedging their bets on a complete unknown. They don't know you. You're just an IP address to them.
Okay, yeah, fair enough. They need to protect themselves from me having absolutely no idea what I'm doing. So what's the next tier up?
Mid-tier. This is where you see the 70/30 up to the 80/20 splits. This is really the industry standard for established, consistently profitable traders, like FTMO, which is probably one of the biggest, most reputable names out there right now. They sit right at that 80/20 mark for their funded traders. And then if you keep climbing, you have the premium tier. That's your 85/15 or even 90/10.
90/10, so I keep 90% of what I make.
Yeah. Firms like the 5%, they can push up to 90/10, but, and this is a massive but here, that is for highly experienced traders who have proven themselves over a long period of time. You don't just walk in the front door and say, hey, I watched a YouTube video on moving averages and suddenly get 90%.
Okay, but let's make this real. Percentages are just abstract math to me. Let's put some actual dollar amounts to this so I can understand the scale of what we are even arguing over.
All right, let's do the math. Let's run a hypothetical scenario here. Say you pass an evaluation and you get let's do a $100,000 funded account. Right.
Entry, 100 grand, not my money. the firm's money.
Right. And let's say you're a decent conservative trader. You pull down, let's call it 5% a month, which, by the way, in the prop space, 5% consistently is a very solid, highly realistic target. You aren't trying to double the account every month. You're just grinding out base hits. So 5% of 100 grand is, 100 grand, so 10% is 10 grand. So half of that, 5 grand.
Right.
$5,000 in actual profit generated for that month.
You're sweating just doing basic division. Yes, 5 grand.
That's the pressure. I'm trying to talk and do math at the same time. Okay, so $5,000 profit. Let's look at the mid-tier splits. Under a 70-30 split, you take home 70% of 5,000. 7 times 5 is 35. So you take home $3,500.
Okay, 3,500.
And under the 80-20 split, you take home 80%. 8 times 5, 4,000. 4 grand. So the actual physical difference between a 70-30 split and an 80-20 split on a $100,000 account, making a 5% return, is $500.
Wait. Go back. The firm keeps, in the first scenario, they just kept $1,500 of the profit I made. And in the second, they keep $1,000.
Yeah. That's their cut.
Wait, that's literally their business model.
Yes. Why do you think they're funding you? They aren't philanthropic charities trying to help you escape your 9-to-5 job.
No, I know they aren't charities, but seeing the actual dollars, $1,500 a month from just one single trader, if they have thousands or tens of thousands of funded traders.
Now you're seeing the scale of the prop firm industry. The volume is astronomical. But look at it from the retail trader's perspective for a second. A lot of people look at that math we just did, 3,500 versus 4,000, and they think, it's just $500 difference. I'll just take the 70-30 offer from firm A because their valuation rules are slightly easier to pass.
Just $500? Are you kidding? No, we need to slow down and look at this. You can't just brush past that logic.
I'm not brushing past it. I'm just telling you how they usually think about it.
You're doing the finance guy thing where you act like $500 is pocket change. Think about what we are actually talking about here. That's $500 a month. Over a year, that is $6,000. That is a decent used car. That is literally months of groceries. That is a vacation. You are leaving $6,000 on the table just because a 7 and an 8 don't look that far apart on a piece of digital paper.
I know. I agree with you completely. And it actually gets significantly crazier when you think about the compounding reality of that money.
Exactly, because if you took that extra $500 every single month, money you already earned, by the way, and you dumped it into your own personal brokerage account, or, wait, couldn't you use it to buy another evaluation for a different prop firm to get more funding?
You absolutely could. That is exactly what the smart traders do. They take the excess profit from firm A, use it to pay the evaluation fee for firm B, and suddenly they're trading $200,000 of capital instead of $100.
So that gap between 70-30 and 80-20 isn't just $500. It widens exponentially over a couple of years. It's the opportunity cost of that $500.
It is. It's massive. But the psychology of it is just so weird. When traders are just starting out, they are so hyper-focused on just getting the funded account, just passing the initial test to prove they aren't losers, that they don't even look at the split. They treat the split like it's the terms and conditions on a software update. They just scroll to the bottom and hit accept. They set it for 70-30 because they're operating from a mindset of complete scarcity. It's like, oh, please, Mr. Prop Firm, just give me some money to trade. I'll take whatever table scraps you offer.
It's treating it like a childhood allowance instead of a legitimate business contract. You are entering a partnership. If a real-world business partner sat down with you and said, hey, I'm going to take an extra 10% of our gross revenue forever just because I feel like it, you would laugh them out of the room. You'd hire a lawyer, but retail traders do it constantly because of, like, the screen barrier.
Yeah, exactly. And here is where it gets really counterintuitive, because you'd think, okay, as I get better, as I prove myself, and I get more money from the firm to manage, my split automatically gets better.
Right. Yeah, obviously. Volume discount. The more money I make them, the better my terms should be. That's how every industry works.
Wrong. It is actually the exact opposite in a lot of cases in this specific industry.
Yeah.
Larger accounts often get less favorable splits.
I'm sorry, what?
Yeah. It's what we call the account size paradox. A firm might happily offer you an 80-20 split on a $50,000 account. But if you step up and request a $1 million account, they might drop you all the way down to a 70-30 split.
Yeah.
Ironically, A $1 million account often gets a worse split than a $50,000 account.
Okay, you are definitely leaving something out here. That makes zero logical sense. Why on earth would I ever want to manage a $1 million account if I am being actively punished for it with a worse split? I just stay at the smaller account where I keep more of my own money.
Because it's not a punishment. It's about absolute dollars versus percentages. Let's do the math again.
Oh, boy. Walk slowly this time. Don't hurt yourself.
I will. Okay, so let's look at the $50,000 account first. You make your standard 5% profit for the month. That's $2,500 total profit. At your nice, shiny 80-20 split, you take home 80% of that, which is $2,000. The firm keeps $500.
Okay. $2,000 in my pocket. I'm following.
Now, you are on a $1 million account.
Mm-hmm.
Same exact trader, same exact strategy, same exact 5% return. 5% of $1 million is $50,000 in profit.
Right.
Even at a quote-unquote punishing 70-30 split, you are taking home 70% of $50,000. 7 times 5.
Yeah.
35. You're taking home $35,000.
Right, okay. $35,000 is significantly better than $2,000, obviously. I'm not an idiot. I understand the absolute dollars are higher, but why does the firm demand that larger cut? If I've proven I can handle the $1 million without blowing it, why are they penalizing my percentage?
Risk exposure. It is entirely about downside risk for the firm. Look at it from the risk manager's desk. Think about what they are actually handing you.
They're handing me a login credential.
Let me give you a better way to visualize this.
Right.
Look, if I hand you the keys to a 1998 Honda Civic with a dented bumper and tell you to go do DoorDash deliveries, that's the $50,000 account. I say, whatever you make, give me 20%. I honestly don't care how you drive it. I don't care if you hit a pothole. I don't care if you brake too hard. If you total it, I'm out a couple grand. It's a rounding error for my business.
Okay, yeah.
But if I give you the keys to a brand new $500,000 Lamborghini Aventador, that's the $1 million account. I am putting a speed governor on the engine. I am installing a dash cam. And I am absolutely taking 30% of your earnings because my downside risk is astronomical. If you crash the Lambo, I am financially ruined.
So the extra percentage is what, hazard pay for the firm?
Basically, yeah. If you blow a $50,000 account, they lose a few grand before their automated systems shut your trading terminal down. But if they hand you $1 million of live firm capital, their exposure is massive. Even with strict drawdown rules like they auto-close your trades if you lose 5%. Markets aren't perfectly smooth. A sudden market gap, a flash crash, some massive geopolitical news event dropping over the weekend that could cause your positions to plummet way past their stop losses before the software can even liquidate them. They could lose tens of thousands of dollars in seconds.
Right, like when the Swiss franc unpegged years ago and brokers literally went bankrupt overnight because the market moved too fast to close positions.
Exactly. So they take a larger percentage of your wins to build a bigger war chest against your potential catastrophic losses. The 30% they're keeping off your $1 million account isn't just pure profit for the CEO to go buy yachts. A massive chunk of that is going into an internal insurance pool, basically, to cover the other traders who completely nuke their accounts.
Okay, I see the logic from their side now. The math adds up for risk management. But it still feels like a massive psychological hurdle for the retail trader. You have to swallow your pride a bit. You have to accept taking a visibly smaller slice of the pie just to get access to a massive pie.
Which is a transition a lot of retail traders completely fail to make. They get so obsessed with maximizing the percentage. They want the 95 to brag about it on Discord, that they completely lose sight of the actual dollar signs.
Yeah.
And the prop firms, the shady ones, they know this. Which brings us to the trap.
The trap. Yes, let's talk about the trap because I love a good scam breakdown.
It is a scam, or at least highly predatory. Because if traders are obsessed with getting the highest possible percentage, they become incredibly easy prey for firms that just dangle bait. I'm going to say this as bluntly as possible. If a firm advertises a 95-5 split, that is almost certainly a red flag for hidden fees.
Wait, hold up. 95.5. How does the firm make literally any money if they only keep 5%?
They don't make money from the split. That's the entire point. If they advertise that high, they are masking something else.
Let's unpack that. What kind of hidden fees are we talking about?
You have to read the fine print. The source material we're looking at for this deep dive specifically calls these evaluation considerations. So imagine you see 95-5 split on the homepage in giant neon letters. You think you hit the jackpot. But then you dig into the terms of service, which is a 40-page PDF no one actually reads. You might find incredibly complex, opaque calculation methods for how that profit is actually tallied. Or you'll see a clause that allows them to make frequent, unnotified term changes.
Unnotified, meaning they can just change the rules of the game while I'm actively trading.
Yes, they can suddenly change the margin requirements. They can suddenly restrict certain instruments like, oh, sorry, we saw you made 20 grand trading gold this week, but we actually just decided, retroactively, that gold is a restricted asset class during high-impact news events. So those profits, they don't count. We're voiding them.
That is unbelievably shady. Are they allowed to do that?
It's in the terms you signed. It gets worse, though. They use mechanics like artificial slippage.
Explain slippage for the uninitiated, like me.
Okay, so slippage is the difference between the price you expect a trade to execute at and the price it actually executes at. In a normal, heavily regulated market, if you click buy at $100, you get it at $100, maybe $100.01. But these shady prop firms, they often operate on a B-book model.
Which means what?
Which means they aren't actually sending your trades to the real market. They are internalizing the flow. They are taking the other side of your trade. If you win, they lose their own money. It's a massive conflict of interest.
Oh, so they are actively incentivized for you to fail.
Highly incentivized. So what they do is, during a news event, when the market is moving fast, you hit buy at $100. They artificially spread the gap between the buy and sell price, and they slip your order. Your software says you bought at 100, but they executed in the back end at 105. You are instantly down $5 a share. And suddenly, you've hit your daily loss limit, your account is breached, and they take your valuation fee.
And you never even had a chance to begin with. But let's play devil's advocate for a second. Let's say I'm an amazing trader. I navigate the slippage. I avoid the news events. I make the money. I see the balance sitting right there in my dashboard. $10,000 profit.
This is the real kicker. You look at the withdrawals. A 95% split means absolutely nothing if you cannot physically touch the money.
Right. If it's just pixels on a screen.
Exactly. You have to look at payout frequency. Some of these predatory firms, they boast a huge split, but they only allow quarterly payouts.
3 months. You have to wait 3 full months to get paid your own money.
Yes. And think about the psychology of what happens in those 3 months. You have the pressure of having 10, maybe 20 grand sitting there that you can't touch. Yeah. You are a trader. You stare at charts all day. What are you going to do?
We're going to keep trading it.
You're going to keep trading it. And because 90% of retail traders eventually hit a losing streak, they over-leverage, they tilt, and they blow the account before the quarter is up. The firm keeps the initial evaluation fee you paid to get in. They never have to pay out a single dime of the profits, and they move on to the next victim.
Oh, that is brutal. It's just a waiting game for them. They know human nature will just do the work for them. And what about when you do survive the 3 months? You try to cash out. Are there fees there too?
Huge ones sometimes, massive withdrawal fees, or they have minimum payout thresholds, like a clause saying you cannot request a withdrawal unless you have at least $2,000 in cleared profit. So if you only made $1,500, you are forced to keep taking risks in the market to reach the threshold, which again increases the chance you blow the account.
Okay, listening to all this, it's like, imagine you walk into a casino, right? But it's totally unregulated. It's in the back of some warehouse somewhere. You sit down at the blackjack table, and you are just crushing it. The dealer is busting. You're hitting blackjacks left and right. The chips are stacking up in front of you, and they look real. They feel heavy in your hands. You're doing the math in your head thinking, I just made 10 grand. I'm paying off my car tonight.
Yeah, you're feeling untouchable.
But then you try to go to the cashier's cage to actually cash out.
And the cage is mysteriously closed.
It's closed. There's a little cardboard sign that says, be back in 3 months, keep playing. or you finally wait 3 months, you get to the front of the line, and the guy behind the bulletproof glass looks at your stack of red chips and says, oh, sorry, we actually changed the exchange rate on red chips while you were playing. Didn't you read the back of the beverage coaster? It says in size 2 font, we can do that without telling you.
That is exactly what it's like. It's a perfect analogy. You are playing in their house, on their servers, using their rules. So if the upfront offer looks too good to be true, if they're offering you 95% right out of the gate, it is because they are making their money on the back end by ensuring you never actually manage to hit the withdrawal button.
So how do you actually get to the legitimate high tiers? Because you said earlier that firms like the 5% do actually offer 90-10. So it does exist in reality and not just as a warehouse casino scam. How do I get that without walking into a trap?
You have to climb the ladder.
Yeah?
You do not just jump straight into a 90-10 offer.
Right.
Legitimate, well-regulated prop firms use what are called scaling models. Traders don't just pick a split off a menu like they're ordering a burger. They unlock them through documented performance milestones.
Milestones, like video game achievements.
Kinda, yeah. So the progression usually looks something like this. You pay for an evaluation challenge. You pass it. You get funded. You start at the baseline, say 70-30. You don't complain. You don't ask for more. You just trade. Then you hit a milestone. Let's say the firm's rule is you need to achieve 10% account growth over a period of 3 months, and you request your first withdrawal.
Yeah.
The firm processes it. They see you are profitable, you are disciplined, you didn't hit any drawdown limits, so they scale your account. They might give you an extra 50 grand in capital, and they might bump your split to 75-25.
And you just keep grinding that out.
You grind it out. You prove consistency over a long time frame. Over a year, maybe you hit a few more profit targets. You show you can handle different market conditions. You survive a bull market. You survive a ranging market without hitting your drawdown limits. Eventually, step by step, you advance to that 80-20 or maybe the 85-15 if you are really elite. The firm models heavily dictate this. Challenge-based programs where you pay a one-time fee to take a test usually offer generous splits, but only after you survive their evaluation phase and prove you aren't just getting lucky with a few massive gambles.
Okay, let me ask you about something else you mentioned in the notes. You said some firms charge recurring fees. Monthly desk fees, platform fees. But if a firm is charging you recurring fees just to have the account open, why would anyone use them? That sounds like another scam. It sounds like a gym membership you can't cancel. Why wouldn't I just go to the challenge-based firm where I only pay once?
Okay, yeah, I need to walk back my harshness on fees for a second here, because there is a legitimate business model here, and it works for a specific type of trader. Fee-charging firms, they aren't always the bad guys. Sometimes they compensate the trader for paying those fees by offering significantly better profit splits right from day one.
So I'm basically buying a better split.
In a way, yes. You are taking on some of the fixed operational costs of the firm. Because the firm has overhead, right? Data fees from the exchanges, platform licensing for MetaTrader or whatever software they use, risk management software that monitors thousands of accounts in real time. That stuff is incredibly expensive. Because you are subsidizing their overhead with your monthly fee, they don't need to take as much of your trading profit to keep the lights on. So they might offer you an 80-20 or 85-15 right out of the gate without you having to spend a year climbing the scaling ladder.
It's an operational choice then. Do I want to pay a monthly subscription fee for immediate premium terms, or do I want to pay a one-time fee, but I have to grind my way up from 70-30?
Exactly. If you know you're a highly profitable trader and you're going to make 10 grand a month, paying a $200 monthly desk fee to get an extra 10% of 10 grand, the math works out heavily in your favor.
Yeah, the fee pays for itself almost immediately.
Right. But regardless of the model you choose, whether it's challenge-based or fee-based, there is a moment in every successful trader's career where everything changes, where the entire power dynamic flips.
Flips how? When is that?
Once you've survived the scaling model. Once you have proven over a long, boring period that you are not a liability to the firm. When you reach that point, you are no longer just a random person on the internet begging for capital. You are now the asset. You are the product that makes the firm money. And when you are the asset, you can demand better terms. You can actually negotiate.
Negotiate. With a prop firm, I thought these rules were carved in stone on their websites. Like, here's the FAQ, do not email us.
The public rules are carved in stone. The rules for the 99% of traders who fail are carved in stone. But behind the scenes, in the VIP support channels, everything is negotiable if you have leverage. You can negotiate your split after 3 to 6 months of documented performance.
3 to 6 months, that's it. I don't need a 5-year audited track record from Wall Street.
In the retail prop trading space, 3 to 6 months of consistent documented profitability is an eternity. Most traders blow their accounts in the first 30 days. If you survive 6 months and pull money out consistently, you are in the top 1% of their user base.
Okay, so let's say I hit the 6-month mark. I want to negotiate, I pick up the phone, or I email support. What exactly am I bringing to the table? I can't just say, hey, I'm awesome, I haven't blown up, give me 90-10.
No, you need a portfolio of proof. You are basically pitching a business proposal. First, you need verified track records.
Yeah.
I don't mean screenshots of your MetaTrader app on your phone with some green numbers. You need the actual back-end data. links to third-party verification sites like MyFXBook. If you have previous accounts with other prop firms where you were profitable, you bring that data too. You say, look, firm A paid me out this much over a year. Here are the withdrawal receipts. Match their offer, or I take my trading volume back to them.
Building a resume. Leverage.
Exactly. The second thing you bring is a demonstration of consistency.
Oh.
And this is vital. I cannot emphasize this enough for anyone listening. A steady 3% monthly gain is infinitely more attractive to a prop firm than a trader who makes 20% one month, loses 10% the next month, and makes 15% the month after that.
Okay, I have to push back on that. Hard. Why? If I make 20% in 1 month on a $100,000 account, I just made 20 grand. I just made the firm a massive pile of money in 30 days. Why would they prefer the boring trader making a slow 3%? 20 is bigger than 3.
20 is bigger than 3, but 20 comes with severe volatility. Let me get into the weeds here for a second on risk management metrics, because this is the core of how firms operate.
Get in the weeds. I want to understand the back end of this.
Okay. Every single prop firm has a maximum drawdown limit. It's their ultimate safety net. Let's say it's 10%. If your account equity ever dips 10% below the starting balance, you fail. The account is instantly closed. Now, the trader who makes 20% in a single month, how do you think they made that?
By taking big positions.
Big positions, high leverage, massive lot sizes, which means their equity curve is probably a terrifying roller coaster. To make that 20%, they might have been down 8% at one point during the month, dangerously close to failing the entire account before the market turned in their favor and they hit that 20% win.
So they got lucky.
Or they just have a very high-risk strategy. Either way, the firm's risk manager looks at the data for that trader and sees a heart attack waiting to happen. That trader is one bad CPI data release, one unexpected interest rate hike, away from blowing the account and costing the firm money. They are unpredictable.
Yeah.
But the boring trader, the one making 3% a month, their equity line is just a smooth, gentle slope upward.
Because they are taking tiny positions. They never even get close to the drawdown limit.
Exactly. They might only experience a 1 or 2% drawdown the entire month. Their maximum open risk is tiny. A trader who never hits their drawdown limit, who never even stresses the firm's risk parameters, that trader is absolute gold. Because the firm looks at that boring 3% and says, we can scale this. They can bump that trader's capital up to $5 million, $10 million, and sleep soundly at night knowing the trader isn't going to blow it all on a rogue gold trade.
So that consistency, that boring, predictable slope, is your actual leverage in the negotiation.
Yes. You don't go to them bragging about your huge wins. You go to them and say, look at my max drawdown. It never exceeded 2% in 6 months. I am completely safe. I am a machine. I want an 85-15 split. And in exchange, I am willing to commit to managing a larger account for you exclusively. You give them stability. They give you a better percentage.
Wow. Okay. Taking a step back and looking at this whole conversation, it's a journey. We started with me being completely shocked that keeping 30% of my money was their literal business model, and then realizing that chasing the highest percentage, that 95-5 trap, is usually just a fast track to an unregulated warehouse casino where you never get paid anyway because of slippage and quarterly withdrawal rules.
And then you realize the real game is surviving long enough to flip the script entirely.
Right. Putting your ego aside, accepting the 70-30 on a bigger account if the absolute dollars make more sense, dodging the flashy marketing, and just focusing on the boring everyday grind of not losing money.
And I want to leave you with a final thought on this, something drawn straight from the source material we analyzed today that really stuck with me. It's the ultimate irony of prop trading.
Lay it on me.
Everyone comes into this industry, especially the younger guys, on social media, thinking they need an aggressive, high-flying strategy to get rich. They want the Lambo, they want the Rolex, they want the 95% split. But the reality is, the most boring defensive statistic you have, your maximum drawdown percentage, is actually your sharpest, most aggressive weapon for getting paid more money.
Protect the downside and the upside pays for itself.
Precisely. Look closely at your own risk metrics before you ever try to demand an 80-20 split. Think about what you're actually offering the firm. Give them peace of mind, and they will give you the money.